Hey, good afternoon, everyone.
Happy Star Wars Day, Mr. Bell.
Thank you, sir. Happy Star Wars Day to everyone. Sure you all know today is Star Wars Day.
Yep.
And if you don't know today's Star Wars Day, I feel sorry for you. So I invited one of my friends to join me today. My good friend C3PO came all the way over from the museum to say hi to us. I was going to take the call from do the Zoom call in the Star Wars Museum, but that seemed to be too much. You know, I got all my stuff right here. So I just figured I'd ask one of my guys to come in here to hang out with you all. So I think as we're waiting for a couple more people to join in, Willie says, play us something on the guitar. Yeah. I can. You just have to stick around after class, and I'll play something. Or you can find some of my performances on YouTube. Actually, my mom and I did a performance that we posted on YouTube a couple weeks ago. You can find us on YouTube. So let's check in, see how everyone's feeling. How's everyone doing?
Good.
Great.
Excellent. Anyone have some plans for Star Wars Day they'd like to share with
I watched the last episode of the Clone Wars this morning, but that's pretty much it.
Yeah, same here.
It's pretty good.
I believe Disney Plus just released the new Star Wars movie, which I
Yeah, they did.
Yeah.
So that's
released
what
that.
our plan is once my homework's done.
Excellent. Speaking of homework, are there any questions about the Module 5 homework? That's all due on Friday. So would I know you had, oh, go ahead, Michelle.
I have a question about the financial plan. The directions for submitting it, it says upload your real one to Canvas, and I understand blocking out some of the numbers, but then you said upload, the second part was upload hypothetical. Is it either or what do you mean by that?
Yeah, so it's either or. So,
Gotcha.
all right, let's talk about the financial plan. Hopefully you guys all saw the announcement that I sent out and more information on how to submit your financial plan. Okay, so I'm giving you 3 options to submit it. And I want to be clear here because I want to find that balance between, I'm going to pause the recording. You can always send me an email or ask me on Wednesday. All right, mutual funds. So last week we were talking about investing in individual stocks, right? And the nerve of me to spend an entire week talking about that when I don't think people when I personally am not a fan of investing in individual stocks. But it's not about me, it's about you. So I want to now talk about how I like to invest, which is in mutual funds. Okay? And we've talked about this a lot in class, but we'll just dive right in. Please continue to ask your questions. Okay? So a mutual fund, it's an investment where a bunch of us, like let's say all 26 of us on this call, say, hey, let's each take $1,000 and put it into a basket or one bank account. So now we have $26,000. Now that we have this $26,000, we can decide how we want to invest that $26,000. Right? So we can buy a couple shares of Apple, we can buy some bonds in McDonald's, we can buy some treasury bonds, right? So collectively, if you're getting what I'm saying, we can do a lot more with $26,000 and spread it out, as opposed to me trying to manage my $1,000 and spread it out, or you individually trying to manage your $1,000 and spread it out. As you've seen, as we've been going along, a lot of these investments have minimum amounts, right? So if we don't have $1,500 or $2,000, we can't even get into this type of investment. Okay? So by pooling our money together, we've got $26,000 to make some decisions. Okay? Now, here's the caveat though, right? We're all putting our money into this bucket, but we're going to select one person that's going to make the decision for us, right? So we all have to trust this person. This person is our professional money manager. Right? This is the individual who is going to take our money and spend that money into what we want to do. Okay? The other thing that's important is we have to make sure that we've set aside what is our objective, right? So collectively, we have to say, what are we planning to do, right? So some of you are like, man, I'm trying to capitalize on this market swing. I want to see 10% growth in the next 12 months. Okay. Well, that means you want to be more riskier than I want to be. So if that's what the 25 of you have decided to do, I'm not going to put my $1,000 in, because that's not my objective. Okay. On the same token, maybe we're all, maybe 25 of us are saying, hey, we don't care about making money. We just don't want to lose money. So let's go find a couple CDs that we can do some CD laddering with, some money market mutual funds. It's going to just preserve our capital, preserve our money, right? And two of you guys go, nah, I don't want to do that. So you're going to go find a different bucket or basket to put your money in. Okay. So it's kind of how mutual funds work. I do want to say this real quick. This professional money manager, that one person, oh yeah, he or she is going to get paid, right? So even though we're putting $26,000 in, we do have to pay this person to manage this money for us. This is his or her job. So I'll pause there because I want to see if you have any questions about what a mutual fund is and how it works.
This person who manages the money is different than a broker, or are they the same?
They could be the same. They could be different. When I think of a broker, Nina, I'm thinking more of a person that's doing the transaction. That's the Uber Eats driver, but not necessarily the cook.
Okay.
But I could cook something and then deliver it. So.
Got it.
All right. So mutual fund categories. There's mutual fund stocks. Okay. So this is when we have what's in our basket, the money in our basket. We say we're not going to take this money and go buy a bunch of different stocks. This is clearly the most volatile, right? So it has because it can rise or fall because we're buying specific stocks, right? So it's still as risky as the stock market. There's fixed income funds. So this is buying bonds. So we talked about bonds a couple of weeks ago. With bonds, we're setting a specific interest rate that we're going to earn, right, over a period of time. And our only risk is that we figure out 2 years later, there's something else we could have done with that money that would have earned more than 3% or more than 4%. Okay? But for us, if we go, look, we just want to preserve our capital. So we're just going to fix our income. That's the option. And the third one, which we talked about even before we talked about bonds, and we talked about it a little bit when we were dealing with talking about savings, are money market funds. Okay, so these are those low risk, short-term investments that are usually issued by government, state governments, local governments, federal government. Questions? Question, C3PO. He comes in, but he doesn't even ask questions. He said he wanted to learn more about stock market. So let's talk about mutual funds, okay? Stock mutual funds. And I want to break this into 3 very broad categories. Okay? The first one is large cap stock funds. Okay? So let me know if I'm going too fast. Large cap. Cap is a short word for capitalization, okay, or market capitalization, market cap. What market cap means is if you take the number of shares outstanding, I think someone asked this question last week, the number of shares outstanding, multiply it by the current price per share, that would be the company's market cap. Okay? So these companies that have a large market cap, you're investing in those companies, right? So these are names that we've all heard of: Walmart, Exxon, Bank of America, Apple, etc. Okay, I'm going to the chat. Nicholas is saying average percentage of fixed funds. You mean like average percent return? If that's your question, the way we find that, oh, thank you, is see what bonds are returning right now. I think when we looked at it a couple weeks ago, it was about 2.5%. And so if you would have invested, well, I don't know. If you would have invested in the last month, you could have made more than 2.5% just by investing in the stock market if you got in and out at the right time. But I don't know when you should have gotten in or out. And so 2.5%, or you could have, but you also could have lost 10% if you got in and out at the wrong time. So 2.5% for some right now is like, hey, it's all I need. And then I think there was another chat just said, I just changed my investments to large cap. Yeah, so large cap is you're really betting on the market as a whole. Okay. Mid cap, so these are companies that are not as big as the large caps. Okay, between 2.5 to 11 billion. What's unique about these types of companies is there's a bigger opportunity for these to make more money. Okay? And also a bigger opportunity for them to lose a lot of money. Okay? We know what Bank of America does. And so Bank of America is not going to have these huge swings going one way or another because Bank of America is, they're in the banking business. Netflix, Netflix could come up with a new service offering that can make their stock jump up significantly or make their stock drop significantly. Harley Davidson, because they're in such a unique, specific market, right? There could be a new player that comes in with the electric motorcycle that would then impact Harley Davidson. So it's subject to more volatility than you would see in a large cap, a large company. And then you probably guessed this, the third one are small cap companies. Okay. So these are between 750 million and 2.5 billion. And I can't even name them because if I named them, you probably would not even recognize their names. But these are the companies who are poised to become the next Netflix or become the next SanDisk Corporation. And so because of that, you can see more volatility, more income, or not income, more growth in their stock price than what you would find in a Coca-Cola, a large cap stock fund, for example. Questions? I don't know if this seems weird, but I kind of feel like today is my birthday. So I've gotten at least 10 different, I'm getting text on my phone right now, 10 different emails, texts, people just texting me, telling me happy Star Wars Day. As if like, and I appreciate it. I'm just, feel like I should like go treat myself or something. My mom did buy me 2 masks. Yes, my mom still buys me stuff. Star Wars masks to wear.
Nice.
Yeah. Have a nice mom. Although I didn't realize. Anyway, Mother's Day is Sunday. Yeah. So. All right. Mutual fund objectives. I'll answer your question in 1 second, Nicholas. So with mutual fund objectives, every mutual fund, right? We're talking about what's the objective, what's your goal, right? So, and again, I want to keep it simple. Their goal could be growth, right? So in other words, we want to see, if the market's going at 6.5%, we want 8%, right? If the market's at 3%, we want 6%, right? So you're looking to grow, which means you're probably investing in more small cap companies. Yeah. Then you have value stock funds. So these are the funds that are not so much focused on the stock price going up of these individual companies, but more focused on the dividends that they're paying out. Dividends are kind of like interest payments, right? Interest income. It's money that you're receiving because you own shares in that company. And so they're investing in those companies that while they may not have a lot of volatility in their stock price, they are consistently paying out dividends, like Ford, Coca-Cola, et cetera. And then, then there's the mixture, right? We want growth and value, right? Those seem, but again, you seem like, well, that seems like the perfect one. But in order to do that, right, this is taking on greater risks, right? Because you're picking and choosing, who's gonna bubble up and blow. And then here, you're focusing just on maintaining your capital, the money that you've invested, and just earning money on that, right? So when you get to here, you're sacrificing growth for income. Where here, you're sacrificing income for growth. Questions?
So they're sharing their growth through which one of the three? It was the blend stock funds. It's hard to see actually.
It's hard to see what?
Well, I can't see what it says for blend stock funds. I'm trying to write it down.
It says invest in a blend of growth and value stocks. It's a mixture of the two.
Can you scroll up for it?
I don't think there's anything below it, but no, I cannot scroll up. But I don't think there's anything else there.
Okay.
When you're looking at mutual funds, do you look for more actively or passively managed mutual funds?
So first of all, let's define what that means, actively versus passively. A passively mutual fund is really not a mutual fund. It's really more of an index fund, which we're going to talk about in a second. In other words, we're tracking kind of what a market is doing or what some companies are doing, and we don't really change a lot. Versus an active fund, it's someone who's actively involved, looking to make changes on a consistent basis, always trying to beat the stock market. And Tyler, this is just my opinion. This is just my opinion. I just don't think people are smart enough to beat the market, you know? And so people are going to get lucky. They're going to take some W's. And when they take L's, they'll just not talk about it. So I'm more into passive managed funds versus active. But I think as you continue to build out your investment portfolio, you start with the S&P 500, and then you kind of say, okay, now I'm ready to venture off. And so you try some other passive funds. And then you go, okay, now I'm ready to venture off. And you try some aggressive, I keep saying aggressive, actively managed funds. Because you do want some of your money, right? 20%, 10%, 15%, I don't know, focused on, let's see if we can beat the market. Kind of want to track the market, but I want to beat the market. Other questions? So this whole thing about mutual funds is about diversifying your risk, right? If you put all your money into Facebook and Facebook goes down for 2 days, right? Their stock price is going to drop significantly. Like their website goes down for 2 days. Their stock price is going to drop significantly. So then your investment portfolio is going to drop. Okay? But if you've got money in Facebook and Google, right now you're diversifying those risks. How's my sound? Is my sound still okay?
It's sort of glitched, but it's fine now.
Okay. I saw that my sign that said internet connection is unstable. So so as you spread it out, right? So now Facebook can have a bad day, but then more people are going to go to Google, right? And so more people go to Google, well, Google's going to blow up, right? But if you're invested in Google and Facebook, you don't get to just enjoy the Google like rise, because you've got Google going up and you've got Facebook going down, right? So you're managing that risk, okay, by investing in companies. So that's what this whole thing about mutual funds. That's why I'm a bigger fan of that as opposed to, buying an individual stock, because I want to manage my risk. So strangely enough, I was thinking on Saturday on my run, I don't know, I heard something that made me think that maybe I should invest in a mutual fund that focuses on entertainment. Because right now, the entertainment industry is getting hit, right? And I'm thinking like Disney's, the movie theater, stuff like that. And so the prices may be lower now than what it would be like, going forward. So that's my thought process. So I start thinking just for a little bit about what I could invest in. And then I figured, what the heck, I'll just do it now. So I looked up a stock or a mutual fund called LSX. It's a Fidelity Select Leisure Portfolio. So I want to show you how you read these mutual fund charts and what's important here. Okay. So the first thing is you want to go to so this is what it's trading at today, $11.64. Which, interestingly enough, when I looked at it on Saturday or Sunday, it was trading at like $12. And I got really anxious because I'm like, man, I know it's undervalued right now. I should just go buy it right now. But then I was like, I'm not sure I know what my Fidelity password is. I don't feel like doing that right now. Let me just be patient. And it's gone down 3%. So I think I didn't jump at that option. Yeah. So that's what it's trading at. And then you can see here some other things. It's beta. Remember, that's how it compares to the market. It's more volatile than the market, okay, because it's more than one. Its yield is about 1%. So that's kind of like what you can expect to earn, which is not very good. And then it's also showing the holding turnover at 53%. So which means like on an annual basis, half of their stock turnover. Okay. Go to profile. And if you look here, so Morningstar is a company that kind of helps rate bonds. And you can see that they invest in large companies and their focus is on growth, which kind of works for me. And then here's something that's really important. Okay, remember I said that, and so here's the person, Becky Baker, who is the money manager for this account. Okay, and a little bit of history about her. But here's what's important. So this expense ratio, 0.76%. Okay. So what that means is for every $100 that I have invested, okay, I have to pay them 76 cents. Now that 76 cents, I have to pay them whether they make money or lose money. Okay. Because their goal is to make money, so I have to pay them for that. This is important because you want to be thinking about how much is it costing me to do this investment. Okay. If you just did a simple S&P 500 index fund, I think it's about it's less than 0.2%. Okay. So you're spending more money in order to do this. Okay. Any questions so far? Another thing to point out is the year-to-date return, which is not surprising, right? This is why I looked at it. It's down 33%, because my hope is that people are selling it now because they're like, I don't know when people are going to be able to go back to, the movies or Disneyland or just enjoy entertainment. Here's what I think is really important. And it's over here in holdings. Okay. So this is just full of information. Okay. So right here, you're looking at, they're 100% in stocks, right? So you're thinking about your risk, right? It's all stock, no cash, no bonds, or anything like that. It's 93% in, they call this consumer cyclical. I'm assuming that means what consumers buy on a cyclical basis. Okay. So it relies on people having jobs. It relies on, the time of the year. All these things are kind of driving consumers' behavior. Okay. So we know right now consumer behavior is low. So most of it's there, and a little bit in consumer defensive. Not even sure what that is. And then this is here, right here. Okay. Every mutual fund, an index fund, is going to tell you what are we investing in. And so here you can see that this mutual fund that I was thinking of, it has so of their top 10 holdings, that represents 72% of what's in their basket. Okay. So 22% is in McDonald's. Another 19% is in Starbucks. Okay, so that's about 41% are invested in McDonald's and Starbucks. Okay. So right there, let's just pause and think about it. Okay. This is me wanting to make an investment. If I don't believe in McDonald's or Starbucks, this is not the mutual fund for me. Because this is what they're banking on, okay, is McDonald's and Starbucks. Very heavily invested in McDonald's and Starbucks. They also have a 5% interest in Chipotle, Hilton, Las Vegas Sands, and then the cruise lines, Yum Brands, that's Taco Bell, KFC, Pizza Hut. I don't know who Booking Holdings or Churchill Downs, I should know that. Vail Resorts, I'm assuming that's some sort of hotel. Okay. So this is important, you all, because if you already own, say you already own 100 shares of McDonald's, right? Then you're already banking on McDonald's being successful. Or if you're invested in the S&P 500, you already own a piece of McDonald's, a piece of Starbucks. So do you really want to press down and purchase more of this stock or this mutual fund? Questions?
Just how did you find out about this specific fund? Did you just go and look it up? I mean, how do you know? So you said that you were thinking about entertainment industry, and then you came upon this, or did you read about it somewhere, or how do you find out about these things?
Good question. So I have a friend, and actually, I'm not sure if this is my friend or not, but I just go to Google and I type in entertainment mutual funds. And there it was right there. So I have an account with Fidelity, so I know that it would be cheap for me to use Fidelity. So this is where I stopped. And then there's also this one. I mean, there's a bunch of different ones that I could have looked at, but I focused on Fidelity because that's where I have a brokerage account with Fidelity. Other questions? So this is what Tyler was referring to, more passively passively, oh my God, I keep wanting to say passively aggressive. Might be in passive aggressive. Passively managed funds. Okay. So a passively managed fund really is more of like a ETF, exchange traded fund, or index fund. They're like kind of two in the same. Okay. So I want to show you all a short video. That I think does a good job of explaining how ETF funds work. This is our friend from Fidelity.
What is an exchange-traded fund? It's simple, really. ETFs are baskets of securities designed to provide exposure to different areas of the market. If used correctly, ETFs may be powerful tools for building solid, well-diversified portfolios. If you want exposure to the S&P 500 index, there's an ETF for that. Brazilian equities, corporate bonds, municipal bonds, commodities, yes to all. Let's look at 3 key attributes of ETFs. The first attribute is hinted at by the name, exchange-traded funds. ETFs trade throughout the day like stocks, meaning you can buy or sell them anytime the market is open. But intraday trading introduces new challenges and costs. As with stocks, you must pay a spread when you buy or sell an ETF. Unless an ETF is part of a commission-free trading program, you must pay a commission too. Be sure to pay attention to any short-term trading fees that may be incurred within a prescribed time frame when selling an ETF. And while most ETFs trade close to their net asset value, you'll want to keep an eye on less liquid ETFs to make sure you're getting a fair price too. ETFs may trade at a price that is higher premium or lower discount to their net asset value. The second attribute is cost. Let's review a few of the reasons ETFs can be a cost-efficient investment. For starters, most ETFs are index funds, which means they track the returns of a market index and are passively managed. This type of passively managed product tends to be less expensive than an actively managed product. Secondly, the ETF structure itself provides cost advantages. Record keeping, transfer agent, and other fees may be lower for ETFs than for traditional mutual funds. ETF companies may pass some of these savings along to you, the investor. Remember, though, to consider the costs of trading the ETF before you buy. Just because it has a lower headline expense ratio does not necessarily mean it's cheaper to own when you consider other costs. The third attribute is tax efficiency. One of the ways that ETFs have the potential to be tax efficient is because there are typically fewer taxable events in an ETF. For example, if you own shares of an ETF and another shareholder decides to sell some of his shares, that shareholder simply sells the shares to another investor, very similar to selling a stock. In this scenario, there would generally be no capital gains transactions for the other shareholders of the ETF. Keep in mind, the tax treatment from one ETF to another can differ, and you should always be sure to read the prospectus for specific details. One last hint when considering ETFs: be careful when selecting which ETF to buy. While many ETFs sound similar, they don't always provide the same exposure. Two different biotech ETFs, for instance, can hold very different stocks, and their annual performance can vary quite a bit. Like any investment, you have to do your research and make sure you know what you're buying. Remember, ETFs are another tool in your investing toolbox, and like any tool, the more you understand how to use them, the more effectively you can put them to work.
Questions about ETFs? Really? No questions? You guys knew that already? All right, so one of the things that the video was talking about is you can buy mutual funds of almost anything, right? Or exchange traded funds or index funds of almost anything, right? And this is to what Michelle was asking. I kind of knew that, well, I could buy index funds or mutual funds in anything. So I just kind of looked up, what are some different types of mutual funds? Okay. Actually, before I do that, let me show you one more thing. Because what I did is I wanted to show you the difference between an index fund and an ETF. I'm sorry, an index fund and a mutual fund. So I looked up what is a mutual fund that focuses in that same or index fund that focuses in that same entertainment industry. And I found this one by Google called Invesco Dynamic Leisure and Entertainment. Okay. So you can see here, more volatile, 1.48. It had a higher yield. I think the yield on the other one was like 91% or something like that. This one's 101. Lower expense ratio, 0.63. Okay. Versus I think the other was like 79.79. I want to see what it was holding, right? So so go to profile first. Let's go to profile. And you can see here, they're more focused on value and medium-sized companies. But my investment in this mutual fund was really about growth, right? Trying to seize a market opportunity. So that kind of turned me off there. As to be expected, it's down 42%. Okay, and let me put that in. That means a year ago, if you would have invested $100, you would now have like $59. Okay. it lost almost half of its value from one year to the next, which is to be expected in this industry with what we're dealing with currently. But I went to the holdings, and I like this more, right? So it's 34% consumer cycles. You can see why it's more value based. It's because it's more, it's spreading its risk out more. Communication services and industrials. And then the top 10 holdings, so their top 10 holdings represents 49% versus the other one I think was like 79%. And I like this kind of spread out more, right? So Chipotle at 6%, Disney 6%, Southwest Airlines, Fox, Hilton, Delta, Viacom, Domino's, United, and the movie theater, AMC. So I personally like this better, but I think it also speaks to my risk profile, right? And who I am as an investor. I think I want to take big risks, but I'm also like, I'd rather play it safe and let's invest in kind of all these at once. Okay. But you can see it's still more advantageous to me to do it this way as opposed to taking, say I wanted to invest $1,000 and just go buy Chipotle stock, right? For $1,000. Because if Chipotle goes down, well, maybe I still have Domino's that can help me, right? Or if Disney tanks, right, I could probably rely on AMC, right? So I'm spreading my risk out, but I'm also spreading out the opportunity to be extremely successful. Questions? So I was looking at this before class, and then my eyes caught over to this PBJ, which I think is kind of cute. It's the food and beverage industry. PBJ, peanut butter and jelly. So, all right. Questions? All right, so let's talk about some get back to our unusual mutual funds. Okay. I think this one's interesting, although I just don't have the, what's the word? I don't have the moral aptitude to invest in this. But there's something called, these are called sin stocks. Okay? And so you can invest in what people's vices are, right? Because the theory is even when the market is good, people are drinking alcohol and gambling and, smoking cigarettes. When the market is bad, people are drinking alcohol, gambling, smoking cigarettes. So the theory is that good or bad, people are always going to succumb to their vices. So that's an example. Another unusual mutual fund is this one, invest in the global economy with the exception of China, right? So instead of focusing on China, right, and you can invest in a market that you go, all right, put China to the side, and what are those other emerging markets that I can invest in? So here, this one invests in, regions like Korea, Taiwan, Brazil. A third, hope you guys are getting these pictures over here. A third kind of funny one is investing in live cattle and lean hogs. So again, very specific. You're investing in livestock, and what are going to be the prices of someone when they want to buy cattle for beef or hogs for bacon. So, or you can do what I did. You think of a market, and you can just go Google it, go find some different types of investments. But I always tell you, be mindful of what are they investing in, and how much is it costing you. So going back to that PEJ with Invesco, I'd have to go back and look and see, well, what is Invesco going to charge me to even purchase some shares in that index fund? Because Fidelity, if I buy a Fidelity fund, they usually don't charge me as a Fidelity customer to buy into the Fidelity funds. So that has to all get factored in when I'm making my investment decision. Questions?
So when you invest into what animals was it, livestock, and it says you can look for you mentioned that you can invest in what the trade of animals or the raising of animals in other countries. Like
You can invest in almost anything.
yeah.
So that one was focused on the future prices of trading cattle or trading pigs, trading livestock. Like if you anticipate there's going to be a shortage or a surplus, that would dictate how you'd want to invest in that. But again, that's way more riskier than saying S&P 500 mutual fund.
Okay.
Right? You know,
That's
I think
true.
that's where you start. And then, you know, as you start to build out your portfolio and you're thinking about how you want to allocate your investing funds, that's when you start to play in some of these other spaces. So you've seen this before when we were talking about stocks, but this is how you calculate what's my expected return, right? We're investing because we expect to make more money than we would make if we had it sitting in a savings account, if we had it sitting in a CD, if we had it sitting in if we had purchased a bond. So to calculate it, you take the initial cost, find the total amount of dividends or interest that were paid during the investment period. You can find the closing sale price of the investment. You add the sum of your dividends to the closing price, and then you divide that number by the initial investment cost and subtract it by 1 to get your percentage. And real quick, I don't think I showed you this, so let me show this to you. Even so, just like with stocks, we can go to historical data and it will show us the stock price of this index fund, okay, as well as any dividends that were earned and when they were earned. Okay, so we can go back to, you know, whatever day we want to look at. Just go here, and we want to know what happened on, I don't know, somebody pick a date like 2 years ago. Thank you. May 4th, 2018 to May 4th, 2019. Or May 4th, May 31st, 2018. Apply. And it tells us everything, the closing prices in May. Trading at $46 then versus $26 now, which should not be too surprising. All right. So let's do one more thing. I'm going to put you guys into some breakout rooms. So go ahead and take a picture of this slide so that you know what all these are different mutual funds, index funds. FAMEX, HCMAX, PRMTX. These are the ticker symbols for different mutual funds. Go ahead and take a picture of that. And I think you all have, more than enough time. So you all have 15 minutes. Don't leave yet, because I don't even know what you're supposed to do yet. 15 minutes to answer these questions. Okay, so what's the fund's objective? What are their top 5 holdings? And then do a little math. If you had invested in this mutual fund, I can't see what it says. I think it says April 30th of 2019. So if you had bought 50 shares, April 30th, 2019, how much would you have gained or lost as of today, May 4th, 2020? Same question, but assume you had bought it in April 30th of 2018. How much dividends would you have received over the past year? How much dividends would you receive over the past 2 years? And then calculate the total return had you invested in 2018 versus investing in 2019. So you might want to take a picture of this screen as well. All right, and then once you have it, you can go to your breakout rooms. And when you have questions, you can invite me into your breakout room and I'll be happy to take a look or talk you guys through it. So Daniela, you should be able to join the breakout room. I think you're in room 3. Okay. The other thing you can do while you wait for it is you can just start working on it. HCMAX, or pick any one of these and work on it that way. Oh, yeah, I didn't know what PK stood for. I thought I was getting old.